there's a chart you need to see. And no, it's not a stock chart. It's not a crypto chart. It's not even a chart that gets talked about on CNBC or plastered across the finance side of TikTok. It's a chart showing which countries are quietly dumping their gold reserves right now. While every financial media outlet has been busy screaming about record gold prices hitting $4,000, $4,500, and beyond, a small group of countries has been doing the exact opposite of everyone else. They've been selling, quietly, strategically, some of them in absolute secrecy until the quarterly IMF data forced the disclosure. And the uncomfortable truth is that when a central bank sells gold in this environment, it isn't boring reserve management. It's a confession. It's a country telling you, in the only language central banks speak honestly, that something is wrong. So today we're going to figure out exactly who is selling, why they're selling, and what it actually means when a country decides to quietly get rid of the one asset every other country on Earth is desperately trying to accumulate. Let's start with the setup because the backdrop here matters. For the third year in a row, central banks globally have bought over 1,000 tons of gold per year. That's more than double their previous decade average of around 400 to 500 tons annually. Countries like Poland, China, India, and Kazakhstan are hoarding gold at a pace that would make a doomsday prepper blush. The reasons are real: geopolitical instability, dollar diversification, inflation hedging, and a quiet but growing distrust of the U.S. financial system. Gold is the asset you hold when you don't fully trust the other options. When trust is high, gold is boring. When trust starts to slip, gold wakes up. And right now, gold is very awake, which makes it all the more bizarre that a handful of countries are going the other direction. And to understand why that's terrifying, you need to understand what gold actually represents in a central bank's reserve portfolio. Gold doesn't earn interest, it doesn't pay dividends, it costs money to store. By every traditional finance textbook metric, it's a drag on returns. And yet central banks collectively hold about 1/5 of all the gold ever mined in human history. Why? Because gold is the asset you keep precisely for the moment when nothing else works. It's the nuclear option, the last resort liquidity, the thing you sell when you're out of everything else. So when a country sells its gold in an environment where gold is hitting all-time highs and every other central bank is buying, you have to ask yourself a very specific question. What do they know that they're not saying? Which brings us to the countries. And we're going to start with the one that almost nobody talks about because it's both the most extreme case and the most quietly embarrassing story in modern monetary history: Canada, the only G7 country on Earth to fully liquidate its entire gold reserve. Zero. Not a ton, not an ounce, nothing. The country that gave the world the Klondike Gold Rush, that produced more gold from the ground than almost anyone in the 19th century, that is home to 4 of the 10 largest gold mining companies on Earth, holds exactly no gold in its central bank reserves. It completed the final sale in 2016 under Finance Minister Bill Morneau, quietly offloading the last gold coins while the rest of the world had already started aggressively buying. The official justification was that gold was outdated in a modern fiat currency world, that interest-bearing, liquid foreign currency assets were simply better suited for reserves management. And sure, that logic made some sense in the late 1990s when it started, right after Bretton Woods had been dead for 25 years and gold had spent a decade going nowhere. But here's the number that makes this story sting. If Canada had simply held on to its 1965 stockpile of about 32.9 million ounces, that stash would now be worth roughly $125 billion. That's not a rounding error. That's equivalent to the entire value of Canada's current international reserves, meaning Canada traded its entire financial safety net for the privilege of being right about gold being boring, right up until it wasn't. Let that sink in. Canada didn't just sell its gold. It sold its insurance policy, and it did it while being the country that literally digs the stuff out of the ground. But Canada isn't even the most embarrassing chapter in gold selling history. That honor belongs to the United Kingdom, and specifically to a decision made in 1999 that became so infamous in financial circles that traders gave it its own nickname. They called it Brown's Bottom, because in May 1999 the UK Treasury did something so procedurally catastrophic it almost seems fictional in hindsight. They publicly announced via a written parliamentary question that they would be holding a series of gold auctions starting in 6 weeks, with plans to sell 395 tons, roughly half of Britain's entire gold reserve. And they announced it in advance, before the auction started, to the entire market. Gold had already been in a bear market for years. The price was sitting around $280 an ounce. And the second the announcement dropped, traders immediately shorted gold, knowing the auctions were coming and knowing the UK couldn't back out. By the time the first auction ran in July, the price had already fallen 10% just from the announcement alone. Britain sold 395 tons of gold across 17 auctions between 1999 and 2002 at an average price of around $275 an ounce, raising $3.5 billion. At today's prices, that same gold would be worth north of $56 billion. The UK bought the bottom of a 20-year bear market, announced the sale loudly enough for every trader on earth to front-run it, and walked away with $3.5 billion instead of $56 billion. And that's not hindsight bias. People in Parliament called it catastrophic in real time. The Bank of England reportedly told the Treasury the decision was political, not financial. Gold traders called it appalling. And the man responsible, Chancellor Gordon Brown, had the price dip named after him permanently. Brown's bottom, the most expensive pre-announcement in modern financial history. Now here's where it gets interesting because those are the historical examples, the legacy disasters, the cautionary tales you write about in textbooks. But the selling isn't just historical. It's happening right now. And the current stories are stranger than the old ones. The Philippines. Not exactly the country you'd expect to headline the global gold sell-off, but in the first half of 2024, the Bangko Sentral ng Pilipinas sold 24.95 tons of gold, making it the largest net seller of gold on earth for that period. More than double the second-place country, and they did this while gold was already rising and the rest of the world was buying aggressively. Their official explanation, they were taking advantage of elevated prices to generate additional income. Smart, right? Sell high, book the profit, rebalance. Except gold then rallied another 45 to 50% from those levels. The opportunity cost of selling early, the money they left on the table, is estimated at close to $1 billion. The Philippine Senate publicly grilled their own economic managers over the decision, and the central bank's defense was essentially, "We thought prices were high enough," which is a sentence that has haunted every bad trade in human history. But here's the one that nobody is talking about on financial media, and it's the most geopolitically significant gold sell-off happening right now: Russia. Because Russia spent the better part of the last decade aggressively buying gold, specifically as a sanction-proof reserve asset after the West froze its dollar holdings following Crimea in 2014. Gold was Russia's insurance against exactly what happened next, and then exactly what they were afraid of happened. The full invasion of Ukraine in 2022, the sanctions, the asset freezes, the exclusion from SWIFT. And now Russia is burning through the war chest it spent years building. Between May 2022 and early 2025, Russia liquidated 71% of the gold held in its national wealth fund, from 554.9 tons down to roughly 160 tons. And in a move that has no modern precedent, Russia's central bank in late 2025 began selling physical gold for the first time ever, directly to domestic banks and state companies, converting bullion into rubles to plug its own budget. For context, before 2025, all of Russia's gold transactions were virtual, internal accounting moves that kept the metal inside state reserves. Now the metal is physically moving. At the same time, Russia banned exports of refined gold bars over 100 grams, selling internally, banning external sales. That's not a coherent financial strategy. That's financial compartmentalization under extreme pressure. Russia's sovereign wealth fund has shrunk from $113.5 billion in 2022 to around $51.6 billion. The gold that was supposed to be the last line of defense against sanctions is now being spent on the war the sanctions were trying to stop. It's a feedback loop that's beautiful, right up until it isn't. Which brings us to the strangest chapter of all: Singapore. Because Singapore is somehow playing both sides of this story simultaneously. In 2025, Singapore's central bank sold 26.5 tons of official gold reserves, a clear reversal from buying 76.3 tons just 2 years earlier. Technically, that makes them one of the larger gold sellers in the world right now. But at the exact same moment, Singapore is quietly becoming the world's hottest private gold storage destination. A 6-story vault near Changi Airport called the Reserve, which holds about $1.5 billion in gold and silver, reported an 88% surge in new storage orders in the first 4 months of 2025 alone, with 90% of those orders coming from outside Singapore. Precious metal bar sales were up 200% year over year. The ultra-wealthy of the world, the people who move first and quietly, are choosing Singapore as their safe harbor. They've taken to calling it the Geneva of the East. So what you have is a country where the government is officially selling gold while simultaneously becoming the preferred destination for private gold hoarding by the global elite. The government is reducing its formal exposure, the world's rich are increasing theirs, both through Singapore. At the same time, if that doesn't make you slightly uncomfortable, you're not paying attention. Here's the real gut punch. This isn't random. There's a mechanism underneath all of this, and once you see it, you can't unsee it. Countries sell gold for exactly 3 reasons. 1. They genuinely believe other assets are better suited for reserves. The Canada argument? 2. They need liquidity urgently, and gold is one of the last things they can actually sell. The Russia argument. 3. They're profit-taking after a major price run and they expect gold to pull back. The Philippines argument. And here's the problem with all three. The Canada argument looks catastrophic in hindsight because you traded a permanent store of value for interest-bearing assets that are only as reliable as the institutions backing them. The Russia argument reveals that gold was working exactly as designed. It's the emergency fund, except they needed to spend the emergency fund before the emergency was over. And the Philippines argument assumes you're smarter than the market. And to be fair, maybe you are. For about 6 months. Then gold goes up another 45%. What unites all three cases is the same thing. When a central bank sells gold at scale, in an environment where every other institution is buying, they are making a bet that the future will be more stable than the present, that the dollar stays dominant, that the financial system holds, that geopolitics calm down, that interest rates stay cooperative, that the things everyone else is nervous about turn out to be fine. Sometimes that bet pays off. Canada's finance officials still defend the decision on technical grounds, but the world is not cooperating with that thesis right now. And the central banks that sold heavily, the ones that needed the liquidity, the ones that thought they were timing the top, are the ones with the least room to maneuver if things get worse. Gold doesn't rise when people are optimistic. It rises when trust is slipping. And right now, the countries that are selling gold are quietly telling you they still have faith in the system. The countries that are buying gold are quietly telling you they don't. Central banks don't make these bets accidentally. They make them deliberately. The question is, who's right? So here's where I want to hear from you, because this one actually has a clean ABC. Do you think A, the sellers are right, that gold is overpriced, the system holds, and in 5 years we'll look back and say selling at $4,000 was smart? Or B, the buyers are right, that the dollar era is slowly fraying, and countries hoarding gold now are simply better positioned for whatever comes next? Or C, the most uncomfortable option, both are right for different reasons, and the real lesson is that national reserve strategy is less about economics and more about which version of the future your government is secretly preparing for. Drop your take in the comments, because this one doesn't have a clean answer. And anyone who tells you it does is either selling something or hasn't looked at the data.